afternoon to that. This is a Wednesday, right after the FOMC meeting. And for those of you who are new to this channel, Due Diligence channel basically teaches you about finance, and we keep up to date with a lot of current news about, the interest rate, the Federal Reserve, what are some, hot meme stocks are there for you to invest, what are some interesting investment strategies that we're using, and of course, we also talk about challenges. What are some of the interesting challenges Patreon members and I are doing to make more profit? What are some good trades that we've been placing? What are bad trades we've been placing in a couple of months or today or yesterday or weekly? So this video's topic, we're going to talk about the FOMC meeting. So what is the FOMC meeting? That's basically a monthly thing where the Federal Reserve do to tell the investors, or anyone to be exact, because the US dollar is essentially the global currency of Earth, right? Assuming that, in this universe, we're Earth 1, then Earth 1's entire economy is actually based on US dollars. For those of you who want another detailed video about why do I say that, comment down below. I will make a cinematic version of that and explain to you guys why US dollar is actually the global currency, and then why US bank, the Federal Reserve, basically will never go bankrupt. But hey, when I say basically, hopefully we don't jinx ourselves. So what are the 3 points that J Money or Jerome Powell talked about today? So first of all, in the following months, our tapering rate is going to be doubled. For those of you who don't really know what tapering is essentially, let's put it this way. So during a pandemic, because just COVID, the government sees, for example, me, Didi, and number 2, who's basically my partner for this channel, or, a lot of our Patreon members are, doing our own things, and, we get laid off, and a lot of people are having trouble dealing with their financial stuff, like paying back their mortgages, might not have a job. Therefore, the government, the US government decided, hey, we're going to give you guys some stimulus checks. But stimulus check doesn't really help directly with, the economy, because they're, when people are selling their stocks, or, generally during an economic depression, people are selling, and then the real asset value will go down. That means, the entire volatility of the market will go up. Then, the regular peasants like us will, worry about the stability of living in the US, and people are gonna panic, riots happens. Therefore, the federal government decided that they're gonna do quantitative easing, which is the opposite of tapering, which just means they're gonna use taxpayers' money to bail out a bunch of companies and buy a bunch of companies' assets to maintain their level of value. Okay, am I making sense? If I am, smash the like button. If I'm not, smash that like button too, but just leave a comment and say, hey Didi, would you slow down a little bit and maybe make a separate video on explaining what tapering really is, and its relationship with quantitative easing, and its relationship with a boom bull market and a market that's during recession? Sure, why not? We can make that kind of video. And the second key point, so go back to the first key point. So for those of you who are just here and listen to me to talk about the result of these policy changes, doubling the tapering rate literally just means it's really good for banks. And you see that throughout the past few weeks, where banks started. If you go and look at JP Morgan, for example, if you go and look at take a good bank that we really like, JPM, right? If you go look at JPM's SEC filings, you will see that hey, a lot of Form 8Ks are filing in the past few weeks, because they have to disclose a lot of the things that they're preparing for, or FWP, or if you go on other consolidated filing, they put out a lot of prospects. Basically, you don't really need to know about the details of it. What does it mean? That they are actually, from 2 weeks ago, you're already seeing the pattern where big banks like JP Morgan and Chase, Wells Fargo, Citibanks, or any other banks you can buy on a public market, BOA, Bank of America, they're already ready for the doubling rate of tapering. Which, if you watch my other videos, you will know that tapering is actually really favorable for banks. Because it will literally increase your profit margin Therefore, you see a very short-term drawdown on the bank stocks. You see like they've been falling a little bit over the past few days before the double tapering rate announcement. And then what's going to happen is in the next few weeks and towards a month's interval, it's going to be very favorable for the banks. And in the long term, it's also going to be very favorable to the banks until the Fed actually announced that there's going to be an actual interest rate hike. Okay, but is it going to be bad for, what is it going to be bad for, right? Doubling tapering rate literally just means it's going to be bad for small cap stocks, and it's going to be bad for stocks that utilize a lot of debt, and it's going to be bad for stocks that relies a lot of governmental purchases that were made in between 2020 and 2021. All right. Key point number 2, the key interest rates stay the same until 2022. What does it really mean? For those of you who are not interested in rate nerd, all you have to know is, hey, there is gonna be a Christmas rally. Basically, that's what it is, okay? And normally we have 40 years of consolidated data on the Fed and on interest rate, and they rarely increase any interest rate on the FOMC meeting on December, which is the FOMC meeting always 1 week or 2 weeks prior to Christmas. It's just basically give us a breather, and you will see a rally next week anyways. But how big the rally is gonna be is questionable, because most people are expecting Fed to increase interest rate around January or March. So leeway and segue into key number 3 is inflation versus rate hike debate. So basically what you need to know, this is a very short version of the explanation, is if inflation is high, one of the easiest way to combat inflation is to increase interest rate. And you guys are like, oh my god, inflation is about like 5 or 6%, it's gonna keep like that. And then the real inflation rate is like almost 3% now. Oh my god, we're panicking. And for those of you who are panicking about inflation rate and you think it's actually going to affect the stock market, we will post a video somewhere around Christmas talking about why inflation actually have nothing to do with the stock market, and we can back it up with big data. But in terms of, for those of you who are like, oh my god, there's such easy way to fix it by just increase the interest rate, and why the Fed is not doing it. Here's the reason why the Fed is not increasing the interest rate on this month, or maybe not even in January. It's because if you go look at the general economic condition, if you look at how many people are taking out loans, how many people are losing their jobs, and how many people are seeking for a specific job that they want, but the job opening is actually not there. And if you actually look at the intrinsic compatibility, basically means how competitive the actual job market is, you will realize that a lot of the people in the United States are actually not actively seeking for a job because they're still on government aid. And then due to that, which means once you increase the interest rate and once taper already end, that means all of these people is gonna run out of money to spend, which is gonna create a huge economic hole in the system itself. So the Fed is really worried because the physical policy making government, which is the administration, Biden or whatever, Democrats, Republican, whatever party you are on, they refuse to really play along with the monetary policy, which means they want not only an interest rate hike, they want a tax rate hike, which will make interest rate hike way worse. And if you have a tax rate hike, it literally means people's consumption will decrease, which means the entire economy is actually going to be going bad, which is bad, right? They refuse to cooperate. This is why on the monetary policy side, the Federal Reserve is really reluctant on increasing the interest rate really quick. And there are some history lessons we can learn from previous interest rate hikes. A very, let's just say, sudden interest rate hike would actually prompt a super high volatility, and it sort of triggers a global market pre-crash. And then when it's actually time for the market to crash, it actually rebounded because everybody realized that a 0.25% interest rate hike is actually not that much. But anyways, what do you really need to take away from this is, if interest rate no matter what happens, there is gonna be a oil and natural gas rally in the upcoming month or upcoming 2 months, depending on the market expectation of when the Fed is actually going to increase the interest rate. And then the energy sector is just going to eat away this fear like so perfectly. And if you guys want me to put a video out on why this interest rate versus inflation debate is going to benefit the oil and gas industry, and because we're in winter right now, why that's going to benefit natural gas, and the fact that lower national reserve of natural gas and energy is going to ultimately benefit traders who are long on natural gas prices, we can also make another video on that. Anyways, this is it for this video. Hopefully it's not too long. This is it. Peace out. See you guys on the upside, and smash a like button and subscribe.